All right, everybody. Hello, my name is Elijah Desmond. I am your host with Closing the Deal Dental Podcast. I'm super excited to bring on our guest, Mike White. He is a legend in the dental industry with 15 years of experience. Mike serves as a principal within the health firm's healthcare industry. Truly passionate about his work, he strives to provide strategic business intelligence by identifying complex financial, operational, and technical issues while developing comprehensive solutions to enhance clients' business operations. Mike is one of the national leaders for CLA, focused on building teams and financial structure, specifically in dental, med spa, and aesthetics groups. Mike is a highly sought after speaker, sharing his broad knowledge of healthcare industry while understanding the complexity of healthcare practices of various sizes. Welcome to the show, my friend.
Thank you, thank you. I definitely got to shorten that out, so we're gonna run out of time just on the intro.
Hey, well, do you like my shirt I wore for you? Look at that.
I love it. Oh, I noticed it as soon as I saw you.
P&L, EBITDA, ROI, AR, and did I mention EBITDA? I figured you'd like that.
Yeah, I mentioned EBITDA. I love it.
Well, hey, we're super excited to have you on our podcast, and this is an extremely educational podcast for all of our viewers. I believe this is episode 6, and it's titled CLA's Role in Quality of Earnings, Building Credibility in Your Valuation. So super excited to get on here and work with you. I know that we have clients that are getting their quality of earnings light done with you, and we're very excited to continue that relationship. Mike, listen, we always kick off this podcast by asking if you were to get on stage and sell your life's work, like this is the big day for you, you would walk into the room and you would play what walk-on song?
Man, I saw this question and I thought to immediately live like you were dying. I'm a country guy, so it's Tim McGraw. And I saw the other one was My Wish, right? Rascal Flats, because I feel like my whole life journey has been about helping others and making sure that, and I think it's so important, those songs, but I had like 3 or 4 in my head as I really thought through that question. Good old Timmy. He's got a few of them.
That's awesome. And I was actually raised in a big farm. I would say that my second favorite genre of all time is definitely country music. I think you may have known I am a DJ. Uh, as well as a serial entrepreneur. And I've been in like 9 different countries and 25 cities in the past 2 years DJing dental conferences.
That's amazing. Yeah.
Yeah. So we figured out how to essentially blend the two. And basically we have all of these sellers that come one at a time in a confidential room. And then you have 10 buyers and they come into the room with their walk-on song.
Oh, that's awesome. I have to rethink of that one. It would have to be more hyped up than like you were dying, but
Yeah. Well, I mean, but listen, if you like that song, it is what it is. So they walk into the room and they get on stage, and then myself or my partner Matt Ornstein interviews them. So, anyways, I like to bring it down to earth. We're all human. We all love. I think most of us. I haven't met one person that doesn't like music.
well, my dad's a band orchestra director. Actually, just retired after 42 years this year, so I kind of grew up around it, more the drum line and stuff, which was a lot of fun. But I don't know if I threw out trying to recruit somebody. I think it'd be regulators, right?
Oh yeah, listen. I was a kid. I probably shouldn't have been listening to the song. It was a tape. I'm aging myself a little bit. I'm 37, but I remember putting the tape in, and I know every single song to that regulator. So awesome, good stuff. Well, listen, Mike, can you tell us about your experience in the accounting world and how you've worked with dentists and other healthcare professionals?
No, absolutely. And you mentioned 15 years and kind of our lead in or whatnot. But what I love about my journey, I think I've related to so many practitioners, business owners that you've worked with and I've worked with, is I'd been on that journey as well. I started my CPA firm when I was 23, 24 years old. That was 2004, right? So we started aging ourselves. I think I noticed more gray hair today than I had before. But I got into healthcare in 2009. I had acquired a 62-year-old dental medical consulting firm and realized this industry was underserved. And of course, that was right at the height of what a management company was, right before the DSO world became such a stigma or whatnot. So we grew up in that journey and we help these business owners and practices, go through it. So
That's awesome. So that's great. Can you I always when I'm talking with the sellers that contact me, they're always confused about what a quality of earnings report is and a quality of earnings light, and I have to go in and explain to them. Can you tell us what exactly is a quality of earnings report, and why is the dentist's current accountant not evaluating the practice at this level, and why is it so critical for the valuation process?
there's a lot to break down in that question. And I'll tell you, so one, what is a quality of earnings report? It is a due diligence package, both buy side and sell side. We do about 250 a year in dental alone. And it's split even, right down the middle, if you will. But what buyers are wanting to do is normalize the financial statements. I will tell you, I've been speaking in this industry for almost 12, 15 years now. And accounting fundamentals is still the number one topic I talk about. And from that, it's people have got to spend time in getting their books in a good position, getting the noise out, getting the one-time expenses, the personal add backs, the boat, the travel, the trips, all the things from a taxation standpoint, great. But from a business standpoint, it's devaluing the business, if you will. So what a quality of earnings does is go in there and normalize the chart of accounts, go through and add back and adjustments, and look at historical, what's going on in the last few years. They're then going to test a few of the numbers. Big ones are payroll, revenue. So is the amount of money you collected, is that actually hitting the bank account? For some of those who always say, yeah, I have this extra $100,000 in cash that I just take home and you don't see it anywhere. Those are things that we've got to pick up and test or figure out if that's accurate. We're looking at the one-time add backs and management adjustments. Hey, Sally Jane's no longer here, or I lost this doctor production. Can you calculate what it would have been had we done a quality of earnings? Or what it would have been performing during that time. On the sell side, it's really getting people ready to go to market and trying to increase the valuation of the business. Say, hey, here's what this business would look like in your hands. Here's how much earnings potential is there when you're running the business versus, my seller's running the business.
Awesome. Can you give us some explanations of like what is exactly in a quality of earnings?
Yeah. Specifically, it's a workbook, right? Good old Excel. But what we're doing is taking all the practice management data, typically 3 years history, P&L, balance sheet, or income statement balance sheet, and we are just taking the P&L and saying, hey, you may have a 3 or 4 page P&L. We're going to get it down to about 8, 9 lines that we really care about. You're going to give us a summary of, hey, Mike, I had this trip I wrote right off, or I had this dues and subscriptions that won't continue. And we're going to help tell your story from the sell side perspective. We're going to walk through the add backs, help you justify the increased valuation in your business from a sell side. From a buy side, we're going to beat down those add backs to make sure that we are buying the asset on a good basis. A lot of this, coming to your first question, a lot of this can be simplified or over easy if we get the accounting right correctly the first time. And when we say a lot of CPAs, why aren't my CPA or why doesn't my bookkeeper just do this for me? Some can, some can't. They just may not have the team.
Right. And we won't take on a client that says, actually, my own CPA is going to do that, or they're going to find the EBITDA. And here's the reason why, is because like this is what you guys specialize in. This is everything that you do, and you're the expert. And I say, in fact, you can actually have your CPA work with them to get them the things that they need. It's not a problem at all. But these are the people that are doing quality of earnings. They're the specialists. Now, here's what I do know. I know that you work with a lot of the major big buyers out there throughout the country, and you're working with sellers as well, 1 to 15 groups, kind of the emerging groups. Can you tell me what is the difference between like a full quality of earnings from one of the big buyers when you're doing these big groups versus doing a quality of earnings light? Like, how would you differentiate the two of them? Because that does need some explaining.
It does need some explaining. And I would say for the most of the buyers in the marketplace today, we aren't even seeing too many full quality of earnings, right? We're seeing a pared back, because dental, when you really look at it, if I can test the revenue and get comfortable with deposits, I know what my payroll is. It's occupying 50 to 55% of my P&L. I know what rent is, 8 to 10% of my P&L, supplies, lab, all the other things. you're pretty much occupying 80 to 90% of the money's in and out with a QOE light. And the difference, if you will, is we're not spending as much time testing. We're not going over the top. We're making sure that the story is normalized, the financials look good, and any of those one-time or add back opportunities are out there, we're getting that story across. And that becomes the big deal. We've even tailored one level down where we say, hey, this is a valuation QE mixture where we do a calc workbook, where we're still normalizing the P&L. We're not doing as much testing, but we're helping business owners who may have neglected their bookkeeping in the past or the financials don't really make sense, get them into a financial position that tells the story of their business and their practice.
That's awesome. You had mentioned something that I love. Everybody loves data. They love ranges. And I know I'm hitting you. If you can't answer it, so
No, please, let's go.
you said payroll is specifically typically this, and there's these ranges. Would you mind like saying the ranges that you average, on average, the ranges that you see for the various things and the quality of earnings?
No, absolutely. And I love this question, right? Because one of the things that we're proud of as a team, as a firm, is we've measured so much data points. And I think it's where we've differentiated ourselves. And we're even getting down to geographic specific, right? What a cost of a hygienist is in Ohio, as we were just talking about it, versus Pac West. Literally had that question yesterday by one of my Ohio partners. But yeah, when I look at payroll, I want sub 50% fully loaded doctor, staff, everything. If I'm going to California, Pac West up there, it's probably 52 to 55. We just got to be honest. That's what it is. We have some practices that are operating below those thresholds, but you just got to be mindful of what kind of service mix and all that stuff. Dental supplies, sub 5. Lab, here's where it gets a little fun. Lab, I say sub 5% if your production per patient's $300 per patient. There's correlations, if you will, in all of that. Same with marketing, advertising, 2 to 4%, depending on how much new patient volume you're growing. And of course, occupancy expense somewhere between 6 and 10%.
Okay, got it. And so when you say the lab expense is supposed to be below 5, I mean, that sounds pretty. Is that for the large groups, or are you talking about the small practices that are 1, 2, 15 locations?
Yeah, no, what I love about that question, and I think the old adage, right? When you and I grew up, I'm a little older, but when you and I grew up, the old thing is if you aren't spending 8, 9% on lab, you aren't doing it right. Well, technology has advanced, the ability for Crown, all of those things have advanced so much, you can get your buying power down to where even if you're managing a really good, practice, if you will, there's that ratio correlation of production per patient to lab expense. It's there.
Okay, got it. And when we talk about supplies, what's this average supply percentage?
So I say sub 5. You see on a solo practice, you see a lot of sub 6. I have some group practices that are doing 4, 4.25, 4.5. But there is buying power, obviously, as you continue to grow. But 4, 4.5 is really crushing it.
Got it. And employee overhead.
Yeah. Employee overhead. So if you look at doctors, going to cost you about 22 to 24, 25%. Employees are going to be about 24 to 26. So fully loaded at 50. So yeah.
That's awesome.
I love data. Yeah.
Let's talk about margin percentage. What do you see as a great margin in general for a practice?
So this is where we really get into not only the practices combined, but corporate overhead. So when you start benchmarking, and I know we're throwing a lot of data points out to everybody, so hopefully this is an episode that's rewound, pause. When you start looking at the practice level, 25 to 28%, all the way up to 32% practice level combined EBITDA. And if you're in QuickBooks, that's net ordinary income or net operating income on that line within QuickBooks or QuickBooks Online. When you fully load with practice management or your DSO corporate, that's somewhere in the 6 to 12% range, depending on what services you're offering. So fully combined, some of the biggest groups in the US are doing somewhere the 17 to 19% fully combined EBITDA, which is great. As a smaller emerging group, you should be above 20.
Awesome. Good stuff. Good stuff. Can you tell me what are the main elements of a quality of earnings report that the dentist should be aware of when preparing to sell their practice?
Yeah. So the main elements, and I would say I'm going to tee this up in the frame of how you can be prepared. So the person listening to this episode, how can you be prepared and get ready? We're going to ask for 3 years, either access to your practice management system. Here at CLA, we have our own scraper. We can grab the data ourselves automatically. We can utilize your Dental Intel or Jarvis or whatever tool you're utilizing, or just get into your practice management system. We're going to want access to your actual QuickBooks files. We're going to want your rent schedules and your actual rent contracts. And we're going to want your employee contracts along with your payroll registers. That's where we'll start. And from there, it just gets into, once we've done our analysis, normalized chart of accounts, then we're going to start having what we call management interviews to really understand, why is your practice different? This is outside the benchmark. Why is that? Is there something here I should be looking for? Is there something you're trying to hide from the IRS, but you don't want to hide from us?
Awesome. And can you say, how does a strong QOV report help build credibility and trust with the potential buyers?
When we look at, go back to your t-shirt, right? EBITDA, it's the common love language of financial professionals. So they want to see their data in a normalized format. And what a quality of earnings does is get them in a format that they're used to seeing, that they can extrapolate the data and apply a valuation multiple to. It gets all the noise out of a traditional P&L balance sheet, where, again, a lot of entrepreneurs run a bunch of stuff through, and it gets all of that out of there so they can just look at what the practice is doing really, and then what it could do in their hands as well.
Now, I'm working with many practices that say something around this. They say, Elijah, like, I really, really want to sell my practice, but what's stopping me is that I haven't filed my taxes yet. My CPA I let go, months ago, or my wife is running the numbers and she's just completely backlogged from the year, and I need to get caught up. When we run into a situation like that, which is often, so like, the dentists that are listening, like, don't think that you're by yourself. Like, this happens to a lot of dentists. And so when we're in a situation like that, did they need to wait to gather that up before talking to you? Or is that a better reason to say, no, call me now so we could do it?
No, when you start thinking about the inflection points and, of course, that journey, right? A process is 6 to 9 months. So in that time, there's multiple steps that we all need to be working on. You and I are working on not only ourselves and our advisors, but also the outside, their wealth manager, their attorney, their, coordinated effort, making sure that the entire picture and team is built out relative to those business. Elijah, I've been, for almost 20 years now, I've been doing a free courtesy analysis of every new business owner / practice that will talk to me. In that time, I've seen less than a dozen practices, financials that I couldn't tear apart. That's a lot. I'm looking at 20, 30 a month. And you start looking at that, that's the average practice owner today. And those are the practices that are devaluing themselves. So get in the hands of somebody like ourselves, a firm that knows the business, knows the industry, what to look for, and how to tell your story to where you can get, better market valuation.
And just so I'm clear, the answer to the question is if your wife is doing your stuff and they don't have anything done, everything is a complete mess. You need to get it done, but they're hesitant to get the quality of earnings. Like, you're saying, no, like, we rock in there. Okay.
Now we can do accounting cleanup to get to the quality of earnings. We can help them shape that story, but no, let's go. There is no time there's no perfect time. People talk to me all the time. It's like, well, it's November. Let me just wait till January. I'll let my other CPA figure it out. It's like, well, if they haven't figured it out for 2 years, don't wait. They're not, let's figure it out. Let's go now. And, we're going to be looking at 2 to 3 years history in those financial package. So it's not just about getting this year right. We also got to go back and make sure we're right going backwards too.
Right. Absolutely. So what are some common red flags or discrepancy that you've seen in dental practices financials, and how can these be addressed before a sale, and how far in advance should a dentist begin preparing their financials in QOV before selling their practice?
So I always say I want you to be market ready at any given time. And I use my own journey when I say that. I started my firm when I was in my early 20s. I exited at 36, 37 years old. And if you knew my entire journey, it wasn't one of those that I was thinking I was going to exit, but we were ready. But there were a lot of events that transpired that said, you know what, now is the time to look. And of course, the market was receptive to that. So we found a great new home for the team. But I tell people that all the time. A terminal illness, a injury or something could drastically change your fortune or your outlook of planning. And unfortunately, I know you've had it as well. As you've come across the practitioner that passed away and his wife is trying to figure it out, or his husband trying to figure it out. So always be market ready. With that being said, the things that you need to be doing today is get your house in order, your legal documents, your bookkeeping, get it caught up. If you stood back and looked at your financials, do they make sense to you? I see so often it's like the intercompany loans. I've loaned $100,000 from this location to this location to get it set up. This side says 100, this side says 50. Where'd the 50,000 go? That happens a lot. I see a lot of expensing for tax purposes, meaning I'm writing off $1 to save 35 cents, but a multiple of $1 is really worth $6 or $8. So was that worth it? You got to figure out what that balance is and how you're doing bookkeeping to drive that valuation home as well. But those were a couple examples.
Thank you. What are some financial mistakes that dentists often make that can negatively impact their valuation of their practice?
Yeah, I'd say devaluing the process overall. A lot of folks know that today's valuation is a multiple of EBITDA. If you can't properly tell your story, if your story, your financials don't make sense to yourself, they are not going to make sense to another person on the outside. And they're going to value you in the same shape that you're valuing yourself, right? I hope that makes sense. If I don't care about my financials, then they're just going to throw a multiple of whatever you don't care about and hope you're happy with it. And this is where we see a lot of practices, devalue themselves. And one example I love to give, and it's an extreme example, but we got brought in to do a bookkeeping cleanup for a larger group that was going to market. Bookkeeping changes. We just cleaned up their books, spent 4 months from their valuation they got before we started to after was a $30 million increase in valuation for bookkeeping.
Wow, that was a large group.
Plenty of smaller ones with similar, proportion percentages. So,
right. How does a QOV report make the negotiation process smoother and more transparent for both sellers and buyers?
I mean, it really does. It makes it a lot easier. If you're going to go into a market as a sell side QE, you've already prepared it, meaning the buy side, they're just going to test and they're going to argue and they're going to try to beat down some of the numbers and negotiate. But you're already there. They don't have to work on recreating your financials. They don't have to try to figure out what's going on. When you've hired a professional firm, somebody like CLA, that we do this all the time, we know what the market is looking for, and we're going to help shape that story so you can shave off some months of diligence. That makes it a smoother process. You also have a good idea of what you think your EBITDA is worth and what you're fighting for when you go to the negotiation table.
Got it. Are there any resources or tools that you can recommend to help dentists better understand the financial side of selling their dental practice?
I mean, do we just go through all your conferences? Do we start there? And then, I tell you, all joking aside, what I've loved about this community and, so thankful to be on here is this is a sharing community, right? You go to these conferences, it's not just listening to me or you speak. The peers are talking to each other. Here's what worked. Here's what didn't work. Here's why I sold. Here's what's happening. Here are good partnerships. Here's not. I mean, it really is a great community that lifts each other up. And I love the conferences for that.
Thank you. And it's funny that you say that. We're actually, recently I moved, you like the title, I moved from CEO of Smiles at Sea and the Dental Festival to CFO. And the CFO in my world is different than yours. Chief Fun Officer.
It's all that title change. I love it.
Absolutely. So the new CEO, she wants to further, my big vision, and ultimately that's create something called Transitions at Sea. And we'll be having our very first Transitions at Sea next February of 26. And I'd love to have you come and speak. I mean, you're just a wealth of knowledge and information.
Yeah.
Yeah, definitely. And so yes, essentially you're saying go to conferences, get educated. I'm very excited to be headed to a Women in DSO in March. I'll be there. Love Dykema will be there as well. The DSO Summit is another one that I'll be at. So Florida Dental Association, I can't forget that. We're actually having the Dental Pitch Brokerage event there where, you got the walk-on song and all the sellers are there, the buyers are there. And it's very fun. So that's awesome. A couple more questions that people ask. mentioned it before. Some people are, some owners are basically getting paid cash, and they're not, let's call it what it is. Sometimes they're taking the cash. And can you like discuss how that affects everything, and can they go and add that back? Like, give a little bit of overview of when you're taking the cash out, and let's just say you're not reporting it, or you are, but regardless, I'm sure you've seen that kind of stuff. Can we talk about that for a moment?
Yeah. So here's what happens. So a couple things to think about, and I don't want anybody leaving thinking, God, Mike and Elijah, they just want us to pay more taxes, right? That's what they're getting at. It's not the truth at all, right? We're just looking at this and saying, hey, how do you properly do your books, but also get the valuation that you deserve for the practice that you built and that legacy you built? If we can't track down, and we've had this situation where we truly could not track down the deposits, what really happened? Did you really take that much out? It doesn't tie to the copay amount. It doesn't tie to this, because we have some people that just won't record the transaction in the practice management system at all. And it's like, I can't give you credit for it. The buyer's not going to give you credit. Maybe they'll put some bonus incentives in there for you to say, great, if you truly can prove it over the next 12 to 24 months, we'll give you some credit, but it won't be at the same valuation that you got, the original deal at. But, when you think about that cash and you think about how am I recording, how am I handling our financials with care, you got to be able to show and prove everything that's happening on the P&L and balance sheet.
Right. So let's talk about $100,000. So say in 1 year, there's $100,000 essentially that's not accounted for. Okay. And they're ultimately saving, I'm going to say 20 to max 40, but say 20, 30%. If it's a distribution, what, 20%. So they're going to save ultimately $20,000 if it's 100 grand. Tell me if I'm wrong, because you're the numbers guy.
You're going down there, right?
Okay, so they're going to save 20 grand from taking that back because they're not reporting it ultimately. Okay, and it's okay if you're listening like, oh my God, this is me, I'm busted. We're all humans, all right. But if I took $100,000 and I added it straight to the bottom line, $100,000 times, I'm going to say 6 is that's over half of that's $600,000. Okay. Now versus your $20,000 that you saved, 20,000, 600,000. I don't know. I think I would probably be reporting it and doing the right thing, and don't feel like a bad person, because I'm assuming this does happen.
No, it happens. And this is the argument I make. It's like, guys, yes, you want to spend $1 to save 30 cents if it makes sense to spend the dollar. I've seen so many practices, I know you have too, where you walk in, you see this, operatory that hasn't been built out yet. And you're like, what's that piece of equipment? Oh, I bought that last year, but I haven't been able to afford to set it up yet. It's like, well, but why? It's just sitting there. Or that piece of software or technology or computers. But you're right, spending $1 and then it costs you $600,000 later. Time and time again, this is where people kind of missteer themselves or planning wrong.
Absolutely. And now I don't want to take you down the EBITDA rabbit hole. We actually had an episode with my business partner, Matt Ornstein, who wrote the EBITDA handbook. But I'm just going to ask the question. So can you go in a little bit to add backs in regards to, like, for example, if I hire a consultant, okay, in 2025, and I want to sell at the end of 25 or say 2026, but I want to grow, and it's $50,000. Talk about that versus if I buy a cone beam now or this year, okay, and that cone beam was $100,000. I paid for it in full, right? Because you have the depreciation with that, etc. Can you talk about the difference between the two and give a couple example of some add backs?
Yeah. So let's I'm going to pick on Smile of the Sea. So let's just say we go to every Smile of the Sea conference this next year, and you promise the new buyer that you won't go the next year. You're upset. I know. I'm sorry. But the reality is okay, great. We can normalize that expense and say, this isn't part of the normal operations of the business. We can give you credit because you're not going to spend these dollars and resources in the future. So we're going to give you a multiple of that spend. You still got the value you wanted. You still got to experience it. You may still choose to pay for it personally. That's fine. And we tell people all the time, when you're thinking about a country club due or advertising or something that you're really wanting to write off, even afterwards, great. They're willing to pay you 6 times now to not, to pay that personally later. So I think that becomes a big thing. So then we go into cone beam. Well, that's an asset. Anything that's an asset and extending the life or adding to an asset on the balance sheet is an add back for depreciation and amortization purposes. cash flow items do not impact your, net income or your earnings. And so many people say, well, Mike, I had $1 at the beginning of the year and $2 at the end of the year, but I'm paying taxes on 4. Why? Then you kind of understand that capital expenditures, distributions, capital assets, things like that.
Got it. So I'm gonna bring that back to go a little deeper for those people who, like myself, don't like fully get it. I pay $100,000 for this cone beam in March of 2025. When I pay $100,000 for that cone beam, am I going to be able to add that back as an add back when I sell my practice in 26, or are we going to have to essentially take into account the depreciation of it? Give me a big picture of that cone beam specific.
Simple answer is that cone beam is not going to be added back per se because it's an asset, right? It did not, anything that doesn't hit your profit and loss statement, right? Number 1 on your t-shirt, if it doesn't impact the profit and loss per se, then it's not going to be added back. Now, the depreciation, so of the EBITDA, depreciation A, DEA, amortization, when that number hits the P&L, that will be added back, right? So that's where the benefit of saying I bought the cone beam, I got the tax write-off, I get to add back from a credit standpoint, EBITDA, depreciation, amortization.
Awesome. Well, people are going to geek out over this podcast. I'll probably watch it a few times myself. You've been amazing. Can you tell everybody how to get a hold of you? If people want to reach out, or are there any assets, anything you want to discuss before we jump off here?
No, well, I appreciate it. I mean, easiest, and hopefully we'll drop my email or whatnot, but 469 974 6693 is phone number. I had to take a minute there, but email's super long. But if you go to one of these conferences, look up. I'm 6'8". I'm around. I'm easy to find, and I'd love to sit down and visit with you. I always do a courtesy assessment for anybody who gives me the chance to meet with them. So take me up on it. Happy to do it.
Okay, that's awesome. Hey, thank you so much for coming, and you're just a wealth of knowledge, industry leader, and very well respected. So thank you for joining me today, and very excited to be continuing to do work with you and send our quality of earnings to you.
I appreciate it. Thank you. Thanks, everybody.
Thank you. Bye-bye.